Gary Peterson is the chairman of Cornerstone Bank in Newtown, North Dakota. And y'all have, I don't think he has any slides, right?
I do not.
No slides, but you have some good comments.
Well, thank you, Tom. Good afternoon, everybody. It's great to be in St. Louis. Tang offered his disclaimer from a Federal Reserve standpoint that his paper and views are his own alone. I have to offer a similar disclaimer because our North Dakota Banking Commissioner is in the room. And so Commissioner Cruz, any opinions expressed by me are mine alone and not of Cornerstone Bank. When Jim Fuchs called me up, there was some reluctance on my part to participate because it's been a long time since I had any involvement in research papers, but Jim assured me that I didn't need to worry about the math or the methods, that my role was to provide color and talk about community banking. And when I mentioned to one of my kids that I was supposed to provide color, she said, "Well, you're good at that." And I didn't necessarily take that as a compliment. So my remarks today are intended to tell the story of my experience in community banking, and I'm hopeful that it goes somewhat to the fine presentations that these three have done in terms of loan loss provisioning and jackpot shocks and commodity price shocks. Just to give you a little perspective about Cornerstone Bank, we're nearly $1 billion bank with 11 locations that stretch from far western North Dakota and to the eastern border of North Dakota, and most recently we expanded into Sioux Falls, South Dakota. We're in both rural communities and metro areas across North Dakota and again into Sioux Falls. We got our start as a family-owned bank in the 1960s. My dad joined a bank, a relatively new bank, that was a whopping $2 million in assets at the time, and began his career as a banker in Newtown, small town where I grew up. Grew the bank nicely, very conservative, agriculture-oriented bank. And as the guys from American State in Williston mentioned, it's a footnote for us too, that as we grew into the 70s, late 70s, early 80s, we had my first experience, my dad's first experience with sort of a mini oil boom and then subsequent bust. So we learned some things and have been there, done that. In 2008, we bought a family-owned bank 17 miles away from my hometown, and it was kind of a big deal for us then. And I thought it was probably very likely the culmination of my career, just because there weren't that many M&As in North Dakota and not that many opportunities at that time. Of course, as you've heard today, there's a lot of change in that regard. So about the same time, there were increasingly oil landmen, is what they call them, in our area. And what the landmen do is go out and seek to lease mineral acres, mineral rights from the people that own them, so that they can maybe ultimately drill for oil. It created quite a buzz because there was a lot of them. The story was that the land people would line up at the county courthouse, do their research, and they'd get there at like 6 in the morning when the county courthouse didn't open till 8, and they would line up their briefcases down the sidewalk just so there was a pecking order of who got to go in first. True story, I saw pictures. So a lot of buzz going around about what these guys are up to because it hadn't happened for 30 years in our area. Well, the buzz quickly turned into something different because almost overnight, all hell broke loose in western North Dakota. There was news of incredible wells being drilled, 2,000, 3,000, 5,000 barrels of oil a day in some of those wells. Whereas if you go back to the late 70s, early 80s, a 200 barrel a day well was pretty significant. So a real game changer for western North Dakota and our country actually, in terms of our ability to become almost self-reliant on oil. But as it was also mentioned in the video, people started streaming into Western North Dakota from all over the country and frankly all over the world. They were coming often without any job in front of them, often without any housing plans, and just were showing up because they read a headline or heard something on the news and saw this as an opportunity. And so many of them were coming not because they had great jobs where they were from, and certainly because they didn't have sterling credit when they came. And so, as you can imagine, trying to open up a simple bank account for a potential customer who gives you his physical address as a 1990 Chevy Suburban located in the Walmart parking lot. Very difficult to do banking. And I'll give you an example. In my hometown in Newtown, Newtown is intersected by two state highways, one running east and west, the other coming in from the north. And by state highways, don't picture overpasses and exit ramps and that kind of thing. These are two-lane roads running into my hometown. And interesting enough, one of the state highways is actually our main street. It goes right through the middle of our town. And prior to the boom, I would say maybe 200 to 500 vehicles a day would be, going down our main street, passing through or doing local commerce. At the height of the boom, there was 12,000 vehicles a day going through our main street. And mostly trucks, semi-trucks, pickup trucks, oil field stuff, to the point where I didn't bother to cross the street to go to the local grocery store. We had zero stoplights, no nothing. And it was a fairly common comment when people would come into the bank and they'd apologize for being late for an appointment. And the reason was I was trying to take a left turn in Newtown. You just couldn't do it. So from 2008 to 2014, our deposits grew 314%, mostly from local royalty income, individuals getting royalty income. And I recall at one point somebody asked my market president in Newtown, what's your marketing plan? And he said, I unlock the door in the morning. Our loans at the same time grew 266%. So to some of your guys' point, with the increase in deposits, our loans increased as well. Our capital grew by 189%. So if you're thinking about those percentages and doing the math, you see the problem there. We were growing too quickly for our ability to retain sufficient capital. I did have, obviously, some questions about the sustainability of what was happening out there. Having been there, as I mentioned, I was somewhat skeptical, but you don't know how many times I heard it's different this time. And so as we were experiencing this just unreal growth, my family knew we had to do something. And so we got together and, like we often did, across the kitchen table and talk about solutions. And everything was on the table. We talked about, potential sale. We talked about, can we borrow away out of this, which we knew we couldn't. Ultimately, we decided to look for a partner. So I had many conversations over the number of months with other bankers, and wasn't getting any traction until I was talking to a banker friend of mine who said, have you considered X Bank, a bank based in Fargo, and I hadn't. But as I quickly started looking at their numbers, thank God for call reports, I was able to see that this could be a very good marriage. At the time, my bank had a loan deposit ratio of about 40 to 45%. As I looked at this other bank, they had a loan deposit ratio of 107% in metro markets, well outside of our area. And so we began a conversation in March of 2014, and in the merger and acquisition world in warp speed, completed a merger by the end of 2014. Very unique story, merging 3 charters, 3 different cultures really, and it was a good success. Unfortunately, after patting ourselves on the back for a kind of a cool merger, oil prices collapsed, and so we were facing that battle. And in 2016, we really took our lumps in terms of loan loss provisions and managing some problem credits. One of Carl's findings is that jackpot shocks cause a deterioration in the loan portfolio. I attribute it probably more just the fact that we had this incredible growth, had to meet demands of our borrowers and new customers. And so, it was largely a case of things being overbuilt, too many hotels, apartments, speculative real estate deals. But fortunately, most banks, I think, remembered the past. And while most of us got dinged in some fashion, there were no bank failures. Want to mention, it's a little offhand, is Rajesh's comment about the loan loss reserve and the fact that it can be contextual. And so that variables are difficult to measure. I appreciated that. And he mentions, for example, portfolio composition, lending shocks, managerial philosophies. And for me, that rings true because for me, as a banker that's been there for a while, whether you're talking backward looking or forward looking, it's a mix based on institution and personal experience, what our internal analysis tells us, what the regulators suggest or sometimes mandate, and what our external auditors warn us about. Too often we hear about too much unallocated reserve or excess reserve, and to me that's often crazy talk. And so oftentimes just as much as gut and instinct as science. I found Carlos' discussion about Section 109 of the Interstate Act affecting the flow of capital interesting. Just the opposite for us in our expansion into Sioux Falls. The Community Reinvestment Act, CRA, is what would limit us, I think, in future expansions. Because what we're finding is the inability to cultivate sufficient CRA eligible loans and investments. There are 30 plus financial institutions in Sioux Falls. Everybody's chasing the same opportunities in a relatively non-diverse economy. And so that is a challenge. Being in banking my entire career, I've learned a lot and continue to do so. Just when you think you have it figured out, events like what transpired can bring you back to reality. And one thing I learned and observed over the last decade that had made a difference is that our stakeholders didn't panic. Our entire team banded together to solve challenges, both good and bad. Our shareholders allowed us the flexibility to manage capital as we thought appropriate. Our regulators are not adversarial in regulatory approach, but instead, while attentive to our challenges, certainly they were constructive in approach and communications. And most importantly, our customers are patient through thick and thin in chaotic times with a highly regulated business where our requirements, both internal and external, can be a bit obtuse at times. I believe our reputation as a solid community bank with strong management sustained us through incredible growth and the following challenging times. And finally, I learned that when somebody says it's different this time, they're probably wrong. Thank you.